Hi, and welcome to With Intelligence's Q&A with Iron Key Capital. I'm joined today by Joseph Argiro, who is Iron Key's CEO. Joseph, thanks very much for joining us today.
Thanks for having me, Sam.
Not a problem. So, Joseph, can you tell us a little bit about yourself and how Iron Key Capital came about?
Sure. I'll start with just a little intro on what Iron Key is, and then maybe I'll go into my background a little deeper. So Iron Key Capital is a digital asset hedge fund that focuses on enterprise adoption of digital assets and the utility behind those digital assets. And what that means is that we're interested in cryptos that are solving real problems, whether that be in the real world or within the Web3 infrastructure space itself. We offer investors a diversified portfolio of emerging undervalued tokens based on our fundamental research framework. Just so a little bit of background about myself. I have a systems engineering and quantitative finance background. I've also been a founder and operator, which is important in terms of the way blockchains work. So I created a web application that was a spinoff of the Uber and Airbnb business model for college touring. Back when the Uber for X was kind of the hot thing in the market back in 2015. And the reason why I bring it up is because that marketplace business model, whether it be Amazon, Zillow, or all the FANG stocks, is that marketplace business model was a business model innovation that allowed essentially like the asset light model. So Uber doesn't own any vehicles, Airbnb doesn't own any cars. So what I realized that back in 2017 is that blockchain is the next evolution of that business model at the technology level. So that's how I really got into blockchain. So did that for a while, then worked on Vanguard's derivatives desk for a couple of years, building valuation models for structured products. And then in the summer of 2017, I really just started reading about blockchain all day. The price of Bitcoin started going up. So I started doing that and essentially started reading about it all day, podcasts about crypto in the gym, every waking moment. So then I after a month or two of that, I realized that, I need to make a career move. So I went to the higher ups at Vanguard and said, we need to settle all of our trades on a blockchain and we need to open a crypto trading desk. Didn't make sense at the time. There was really no market for it back in 2017. So I moved on and I joined a crypto startup called ICOalert.com, which was a platform that allowed early crypto investors to connect and invest in the ICOs back in 2018 in the first bull run. So from that, I really saw, about 50 to 100 data points on every blockchain startup that ever existed. So that's where I really got into the crypto space back in 2018. And then when the market collapsed, I knew I wanted to be in the investment management space in crypto. Wanted to get more experience. So I ended up working as a product manager in blockchain strategy for Hewlett Packard Enterprise. So did that for about 3 years, was really where I learned all about the research aspect of really big data and IoT technologies is really what I focused on mostly, which is really the foundation of why I decided to launch Iron Key about 9-10 months ago.
Wow, so you've been there kind of seen it all when it comes to blockchain, crypto, and obviously clearly done your research and hence kind of making that career change and doing all the background work that's done into it. So hats off for doing there and going for it. I mean, you're very much a crypto native fund. I was wondering if you can share with me and our viewers how you've seen technology evolve and improve the crypto fund space. I know obviously you mentioned a bit there the Internet of Things and all around that. I wonder if you can kind of dive a little bit deeper there.
Sure. Yeah. So the crypto space, it's amazing how much it's progressed and evolved and matured over the last 4 or 5 years. One of the aspects is very much around the infrastructure for funds. So at the time, back in 2017, there was a couple of fund administrators that supported the space, but not many, and their technology was not really crypto savvy, as well as there really wasn't many custodians, because custodianship is a big piece, because these are bearer assets, like cash in your wallet. If it gets stolen, it's gone. So there's a lot of security measures that need to be put in place to allow an institutional offering here. So seeing those different building blocks come in and mature has made the process a little bit easier. It was very difficult to launch a crypto fund back in 2017, 18. Now it's a lot easier. And you're seeing that a lot more crypto funds are coming in the market. And that's really just because I think that cryptos, it's a new asset class and a new technology, and really there's a lot of opportunity for active management in the crypto space. Also on just the fee side, given that the returns in crypto can be quite high, which can justify some of the the hedge fund type fees as opposed to other asset classes. And what we're seeing is that people and institutions are realizing that most people and funds are advocating for 2 to 5% of their portfolio assets to be allocated to crypto as a hedge. So you're seeing funds emerge that kind of fill that need in one's portfolio. So as far as the technology, that's how the technology has evolved in the crypto fund space. One good example is the crypto exchange FTX. What they're actually doing is allowing positions in the derivatives market to be cross-margined, which brings a level of sophistication in portfolio management to crypto that was never seen before. So that's an example of how the institutionalization of crypto is coming to the forefront. Another good example that we actually leverage at the fund is Wyoming, the state of Wyoming's regulatory framework. So we're based in Wyoming. And the reason why I bring it up is because Wyoming is at the forefront of this digital asset regulation. And what they've come out with is a new type of banking charter called the Special Purpose Depository Institution. And what that is it's different than the traditional banking fractional reserve structure, where these crypto banks are required to have 100% of their assets in custody, so they're not going out and lending them out to other people, which allows for our fund to have benefit from different operational efficiencies in terms of leverage with different stable coin rails, and converting cash to crypto and US it's almost seamless, and with the technology that these crypto native banks are building. So it allows us to really operate at a save dollars on our bottom line in terms of operational efficiency. So that's just one emerging trend that's actually coming out this year in 2022 that we're leveraging.
So, as stated, a lot of people are looking to go more into crypto and to learn about it, frankly, because they do struggle to understand what it is, what it means, and leads into this question: how will crypto look to impact the fund space? What are kind of your thoughts around that?
Yeah, so I think at the portfolio management level, you're continuing to see traditional funds and existing funds dabble in crypto, whether that's holding a Bitcoin position as a hedge, or in more sophisticated investing in the actual. Everything else is really more like a venture style investing model, I would say, everything besides Bitcoin. So you're seeing that as a hedge, right? Because what we're seeing is that crypto is it's very correlated with traditional assets in the short term. And we're seeing that because crypto is becoming an institutional asset class. So, it trades with other risky equities and things like that. But in the long run, what we've seen is that the correlation to other asset classes is really low in the long run. And what that gives us allows us to infer is that, there's a lot of asymmetrical upside here in the crypto market. And really with crypto as a hedge, you can actually reduce your overall portfolio risk by holding asymmetric assets that are not as correlated to the rest of your portfolio. So That's really the main gist of the asymmetric trade that we're seeing in crypto right now.
And what about when it comes to building valuation models and evaluating digital assets? I mean, IronKey leans into the venture style of investing, so it'd be interesting to hear your views on that.
Yeah. So first thing I would say is top down, more macro. How we look at the crypto market is, we break it up into different sectors. So the first would be Web3 infrastructure, which is your smart contract platforms, which is Ethereum and its competitors. There's also metaverse and NFT type infrastructure technology. And then the third is decentralized finance. So these are the high level buckets that we look at, and just kind of looking out, 6 to 12 months of where we should be allocating. So that's kind of the sector analysis that we're doing. And then as you move into, evaluating specific crypto projects, there's a couple different things we look at. So we definitely take a venture capital style approach to evaluating these assets. And what that means is, one is really around founder market fit. So, are these founders, they have the background and, the skill set to pull something like this off. The second would be, the total addressable market. How big is this opportunity? And some of the questions we ask is really, is this technology ready for the world? And is the world ready for this technology? So those are some of the things we're thinking about. In terms of the actual, I'll say, fundamentals, we look at it from a supply side and a demand side perspective. So the supply side is more quantitative and concrete, and is analogous to traditional finance in the sense that, we're evaluating what we call tokenomics, which is essentially the amount of shares outstanding in a blockchain network. And there's, things like token buybacks, share buybacks. There's a lot of similarities here. So this is a quantitative analysis fixed, and projecting how these tokens are going to be released into the market over time. So that's the supply side. The demand side looks more similar to traditional venture investing, and trying to predict, where's the demand for this type of crypto-based service? How is that demand, going to grow in the future, and who's the target market for this type of service? So those are the two ways we evaluate these things. So in terms of the valuation models and how we're going about building these valuation models, is that now in crypto in 2021, we're actually seeing that some of these protocols are producing actual cash flows. So with that, we can start to, build a valuation model around those cash flows. And really what we could do is look at different, I'll call it price to earnings ratios, but they're a little different in crypto. The network value to transaction ratio is one of them. But we use those, which the protocol revenue is an input for, in order to arrive at a relative valuation based on the sector we're evaluating, and able to line up these different assets, whether it be, Ethereum and its competitors as an example, and being able to see, how cheap is this asset? It's a little earlier on in its life cycle, and it's trading at a discount, but probably for a reason relative to some of the more established and incumbent cryptos. So that's really some of the relative valuation that we're doing.
It's interesting to hear how it's done, and really looking forward. Then, what's kind of your view on the outlook for crypto in 2022 and beyond?
Yeah, so the future is incredibly bright for crypto. Given that in 2020 there was less than 5 billion in venture capital raised. In 2021 there was over 25 billion. So you'll eventually, over time, see those private financing rounds make their way into the public liquid crypto markets. It's just, what's more of a question is, what's the timeline on that? And we saw a huge run up in 2021, with Ethereum up almost 400% and others up more than that. So, we're starting to see that, some of these valuations come back down to reality, which is a good thing. It's healthy for the ecosystem in the long run. And right now, I think we're really pricing in just about all of the fear and uncertainty around the Russian war and World War III, and really around the global macro tightening environment, which the crypto market is being affected by, absolutely, in the short run. But I think we've really priced in as much of that as we can at this point. And it might be 3, 6, not 9 months until we see the next leg up in crypto, but it's definitely coming. So it's really about preparing for that and allocating to where the market's going to be going in the next run up.
No, that's brilliant. Look, Joseph, it's been a pleasure chatting to you and hearing your views on IronKey and where the market is headed in terms of crypto. Is there anything you'd like to kind of end on there? Any words of wisdom you'd like to impart before we say goodbye?
Sure. I would say, just relative to the 2022 outlook, is that, in 2021, we really saw a bull market in some sectors in crypto and a bear market in others. The DeFi space underperformed massively, whereas the smart contract platforms and layer ones really dominated the market. I think we'll see something similar in 2022. In terms of, the metaverse and NFTs is really not slowing down. So we'll see. I think it's likely that we'll see, not a prolonged bear market, or maybe a more mild bear market relative to 2018, but the future is definitely bright. And really, the way we're allocating in 2022 is really around protocols that are bridging the gap to the Web 2 and the FANG stocks. So think about, Google and Microsoft, and all of these big tech companies are trying to figure out what their blockchain strategy is. And we think that they're going to eventually tap into some of these more public blockchain infrastructures. So the blockchains that get adopted by big tech stand to have, a big year, maybe this year or the next. So that's really what we're watching out for in 2022.
That's great. Joseph, thank you very much for joining us, and thank you everyone for watching. Thank you very much. Thank you.
Thanks, Sam. Thanks for having me on.
Thank you.